Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Now is the time to remember the stock market goes through economic cycles and it always recovers from bear markets, often when investors least expect it. Joining me to discuss the Spruds Powell, managing director with Kayne, Rudnick. It's great to see you, Spruds. Welcome to Trade Talks.
Thanks, Jill. It's nice to visit with you today.
You got it. And what are one of the common mistakes investors make in this type of cycle?
I've always felt that the most common and arguably the worst mistake investors make is letting their emotions influence their judgment. And these days, needless to say, there are a lot of investors who are frightened and in many cases shooting from the hip. And so I spend a lot of time trying to talk investors off the ledge.
What are two of the biggest risks of inflation?
There are lots of risks associated with inflation. Two of the biggest risks would be first, the threat that as inflation remains high, the input costs for a lot of businesses increase, and that can have a detrimental impact on their profits. So for example, if you make cars and the cost of leather and steel and chips rises, unless you can pass those higher costs on to your customers, that will take a bite out of your profits. And the second risk that is associated with inflation is the threat that as the costs of goods and services increase, eventually consumer spending slows down. You know, at some point, if it's too expensive, people will stop going out for dinner and buying new clothes and paying for those airline tickets. And given that consumer spending represents 70% of our economy, if we saw a material decline in consumer spending, that would create some challenges.
Yeah, we'll hear about that certainly over the next 3 to 4 weeks as we enter, or actually peak earnings cycle. So I guess, Spuds, the obvious question is, how much longer can it last? Are we in a recession? Have we hit peaked inflation? Has the market bottomed? I'm sure you get these questions day in and day out.
I do, and obviously it's really difficult to address the questions. And you know, one of the major contributors to the fear factor that exists today is the uncertainty around inflation and how much longer are we going to be facing such high inflation rates. There are lots of factors that contribute to high inflation. You know, there's the war in Ukraine and the impact that that's having on the price of oil and other commodities. There's the fact that China has, to a large degree, shut down to cope with COVID, and that's impacting manufacturing, which is having a negative impact on supply. The Fed has obviously started to take steps to tap the brakes on consumer spending in an attempt to try to reduce inflation. And so there's just a lot of unknowns out there, and that uncertainty makes people nervous. You know, when the future is unclear, it's human nature for people to dwell upon the bad things that could happen as opposed to the good things that could happen. And so it's just really difficult to try to kind of wrap one's brain around these uncertainties and predict just how much longer we're going to be facing higher inflation.
And then, Spud, speaking of looking into the future, capital markets are forward looking. And so how do they typically respond when we get new information and data out?
You're absolutely right, Jill. The stock market in particular is a forward looking creature. And what I think a lot of people underestimate is the fact that stocks don't move up or down based upon whether news is good news or bad news. You know, typically stocks move based upon whether new information is better or worse than anticipated. You know, these days, the analogy I've been using with folks is a weather analogy. You know, fortunately, thanks to the strong job market, the strong housing market, strong consumer spending, strong corporate earnings growth, we've been living in a lot of blue-skied, sunny, warm days. You know, these days, however, a lot of investors are predicting that there is a snowstorm on the horizon. And my best guess is that we're probably not facing a snowstorm anytime soon, but we probably are facing overcast, you know, maybe 50, 60-degree days. And if that's the way things unfold, my prediction is that when investors start to realize that we're not facing a snowstorm, and things start to turn out less badly than anticipated and less badly than what's been priced into the markets today, the stock market will start to recover right when people least expect it.
Right. And something that stood out in your notes more than anything was the fact that you said recessions can in fact be healthy for the market. Explain to us what you mean by that.
Well, the analogy I use there is a forest fire analogy. During a forest fire, there's a lot of devastation. But following that forest fire, there's sort of renewed growth and the green shoots that come from that fire. And I think the same is true with recessions. Recessions can be very effective in this case at reducing inflation. Recessions can be very effective at sort of weeding out a lot of the fat that builds up and weeding out a lot of the frivolous sort of speculative investing that takes place. And that tends to set up the economy for renewed growth. One of my observations these days too is that a lot of folks tend to reflect back upon the horrible recession we suffered through in 2008. The word recession is very scary, but I would argue it's scarier today than just about ever before because of the severity of the recession that we all remember back in 2008. And one of the things I'm reminding investors these days is what we went through back then was unusually difficult. It was the second worst recession in our country's history and very atypical. The more common recession is one that's much less painful, much milder than what we experienced back then. And so I'm reminding investors of that these days.
Yeah, and I would agree with you. I remember going back through 2008 and 2009 as well, and it was certainly more systemic than perhaps what we're seeing now. And we had a structural breakdown in what was happening with our financial system. And you're not seeing that today like we had seen in 08 and 09.
That's right. To add to your point, today we've got an unusually strong job market. Today we've got an unusually strong housing market. And today we continue to see businesses that are growing their earnings. And so I think it's easy to predict that going forward, some of that unusual strength and some of the healthy growth that we have been benefiting from will start to slow down. But that's a far cry from falling off a cliff and entering into a severe and long-term recession.
All right, Spruds, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
It's my pleasure. Take good care.